Welcome to the history of money. Money is an essential part of our lives and plays a crucial role in society. It allows us to exchange goods and services and serves as a store of value. But have you ever stopped to think about where money comes from and how it has evolved over time? The concept of money has a long and fascinating history, and understanding it can give us a greater appreciation for the financial systems that shape our world today. In this video, we'll be tracing the evolution of money from its earliest forms all the way to modern electronic currency. We'll explore the different materials that have been used as money throughout history, including precious metals, shells, and paper. We'll also look at the role of central banks in controlling the money supply and the various benefits and drawbacks of different forms of money. So join us as we delve into the rich history of money and discover how it has shaped the world we live in today. Early forms of money can be traced back to ancient civilizations, where various materials were used as a medium of exchange for goods and services. One of the earliest forms of money was bartering, or the exchange of goods and services directly for other goods and services, without the use of a medium of exchange. This could be as simple as trading a sheep for a bag of grain. As societies became more complex, the need for a more standardized form of exchange arose. Precious metals, such as gold and silver, were often used as money due to their rarity and ability to be easily recognized and valued. These metals were either fashioned into coins or used in their raw form. Other objects, such as shells and beads, were also used as money in some societies. These objects were often chosen for their rarity or aesthetic value and were used as a medium of exchange in trade. Overall, the early forms of money were chosen for their perceived value and ability to facilitate trade. As societies continued to develop, more standardized forms of money, such as coinage, would emerge and eventually pave the way for the modern financial systems we have today. The development of coinage marked a significant milestone in the history of money. Coinage refers to the use of standardized metal coins as a medium of exchange. The use of coins made it easier to conduct trade and transactions, as they were easier to carry and divide than larger forms of currency, such as precious metals in their raw form. Coins also had the added benefit of being more difficult to counterfeit, as they were made of metal and often bore the insignia of the issuing authority. The first coins were believed to have been developed by the ancient civilizations of China, Greece, and Rome around 700 BCE. These early coins were often made of gold, silver, or bronze and were used to facilitate trade and as a store of wealth. The ancient Chinese used copper coins with inscriptions on them, while the ancient Greeks and Romans used gold and silver coins with images of their gods and rulers. The spread of coinage throughout the world was facilitated by the growth of trade and the expansion of empires. As coins became widely accepted, they became the dominant form of currency in many societies. The Roman Empire, for example, used its coinage as a means of extending its influence and promoting trade throughout its territories. The use of coinage allowed for the creation of a more complex financial system, including the development of banks and the issuance of paper money. The widespread adoption of coinage laid the foundations for the modern financial systems we have today. Without the development of coinage, it's hard to imagine what our financial systems might look like today. Paper money is a form of currency that is made of paper or a similar material and is issued by a government or central bank. The use of paper money began in China during the Tang dynasty, around the 7th century CE. These early paper notes, known as jiaozi, were used as a substitute for coins and were backed by deposits of gold or silver. The use of paper money spread to Europe in the 17th century, where it was first used by the Swedish central bank as a means of financing military expenses. Other countries, such as France and England, soon followed suit and began issuing their own paper money. Paper money has several benefits over other forms of currency, such as coins. It is easier to carry and less prone to wear and tear, and it is also easier to produce in large quantities. These advantages have made paper money the dominant form of currency in most countries today. In fact, it's hard to imagine going about our daily lives without the convenience of paper money. However, paper money also has its drawbacks. One major issue is the risk of inflation, or the decrease in the purchasing power of money over time. When a central bank increases the supply of paper money without a corresponding increase in the supply of goods and services, the value of each individual unit of currency decreases. This can lead to higher prices and a decrease in the value of people's savings. Another issue with paper money is the risk of counterfeiting. While advances in printing technology have made it more difficult to produce fake paper money, it remains a concern for governments and central banks. Counterfeiting can lead to economic instability and can undermine the trust in a currency. Despite these drawbacks, paper money has played a significant role in the development of modern financial systems and remains the dominant form of currency in most countries today. Its convenience and ease of use have made it an integral part of our daily lives. In today's world, electronic money, such as debit cards and digital currencies, is increasingly prevalent. But what exactly is electronic money, and how does it work? In this video, we'll be exploring the various forms of electronic money and the role of central banks in modern financial systems. So, what is electronic money? Simply put, it is a type of currency that is stored and transferred digitally, without the need for physical coins or notes. Electronic money can take many forms, such as debit cards, mobile payments, and online banking. One of the main advantages of electronic money is its convenience. Transactions can be conducted quickly and easily, without the need to carry physical cash. Electronic money is also more secure, as it is less vulnerable to theft or loss. But what about digital currencies, such as Bitcoin? These are a type of electronic money that use decentralized networks and cryptography for security. Digital currencies are not issued by a central authority and are not backed by a physical commodity, such as gold. While digital currencies have gained popularity in recent years, they remain highly volatile and are not yet widely accepted as a form of payment. In addition to electronic money, central banks play a significant role in modern financial systems by controlling the money supply and setting interest rates. Central banks can use various tools, such as open market operations and reserve requirements, to influence the supply of money in the economy and achieve their monetary policy objectives. In conclusion, modern forms of money, such as electronic money and digital currencies, have brought convenience and efficiency to financial transactions. These innovations have made it easier to store, transfer, and spend money without the need for physical cash. However, they have also raised new challenges and complexities, such as the risk of inflation and the potential for fraud or security breaches. Central banks play a crucial role in modern financial systems by controlling the money supply and setting interest rates. These institutions work to maintain financial stability and support economic growth, but they also face the challenge of balancing these objectives with the need to respond to changing economic conditions.